Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back here in the home podcast studio to deliver today's podcast. Got a lot of very good topics today. We got some viewer questions that we want to address. We also have what I'm going to call the three primary reasons the market will rise in 2024. So I'm excited to share that with the viewers. What do you got on your mind here today, man? I'm loving the new headset microphone. Looks
Yeah.
cool. Sounds great.
Thanks, man. I'm going like full e-girl today, so
I love it.
actually let me
Yeah. So we actually are going to address a lot of stuff here today. One thing I wanted to talk about real quick is Shepherd Wealth Management. We do a lot of cool stuff. You can go to shepherdwm.com. You can check all the newsletters that we've done since January of 2023. We have like 659 videos on YouTube. This is season 4 of our podcast. And we also put all that stuff on Spotify. So shepherdwm.com, a lot of cool stuff there that you can check out. You can leave us questions. There's a whole bunch of information about myself, how to contact me, email, text, phone calls. So we'd love to get your questions. We have some of those today that we do want to address. And love your feedback. So if you like the show, don't forget to subscribe on YouTube, like us, share it with those that you think might benefit from this kind of information. Why we do what we do is a lot of individual investors out there have a difficult time controlling their emotions. We talked about this last time. Psychology tells us that there's 27 different emotions that any of us can have at any one point in time. And typically we're very, very busy people here in this country. And we have these smartphones on us 24/7. So if you're like me and you have, a family, kids, dogs, career, a lot of the news that you get might just be what you see on your phone, which is typically, headline news. And it is information that you'll want to know about. We talk about those things here. But the one thing that we provide that I think the news does a terrible job of is they do not provide a lot of historical precedent. Meaning that, yeah, the news might be bad. Headline news might sound scary, but there's also maybe 27 other times we've been through something very, very similar, and the outcome for investors is actually quite good over the next 6, 9, 12 months. So people just don't have the time to go about looking through that market data history. We do. Thankfully, this is a skill of mine, a talent that I've been blessed with, and I'm happy to share that with everybody. It's how I make my living, of course. But I'm also thankful for those that are super busy and maybe don't have all day long to do what I do that allows me to have the career that I have. So I wanted to spend just a second letting everybody know that Shepherd Wealth Management has also come out with its own app. It's also available on Android and Apple devices, so everybody gets to participate. It is really cool. You can find it just by searching Shepherd Wealth or Shepherd Wealth Management. You're going to see a sign, like a logo that's just like the one that's sitting over my left shoulder right now, is what the app looks like on your phone. And it truly would help. It's mostly designed for our customers, although you can connect any financial institution, to that app itself. So you can have, a really cool dashboard. But for our customers, since it's integrated with Charles Schwab, that's who we custody all of our accounts for. They can see the performance of their Schwab accounts that we're managing for them. They can add other accounts if they want to. We won't be able to see those accounts, of course, if they want to add it to their phone. But it breaks down all their performance over any period of time. It shows them their positions, any cash in the account, any transactions that we do. But more importantly, all the stuff that we do for our customers. We do a monthly newsletter, a Friday blog. We do these podcasts every 2 weeks. All the stuff that we do, content-wise, we will push that out through the mobile app right to their device. That way they'll never miss an episode. They'll always have all the information right at their fingertips, including all their performance. And it's just a very cool way to interact with our customers and keep them informed. And it's, quite frankly, way better than the Charles Schwab mobile app itself. So I'm very proud of that and happy to share that news with everybody.
That is super awesome. And what about crypto? We can't leave Gen Z out. Can you get your crypto wallets on that?
You can, if it's a position in the portfolio, sure.
Yeah,
You can add outside accounts like I mentioned. So yeah, you can definitely do that.
that's tight. I'm gonna have to check that out.
Yeah,
Get a little
very cool.
employee discount on that.
It is a free app. no doubt. So it is cool, but it's way cooler for our customers because we can interact with them in a pretty convenient way for me instead of sending out 250 individual emails every time we do these things. And again, we do a lot of stuff every week.
Yeah.
Which is going to be cool. So anyway, getting back to the show here, Ez, we got some
Yeah.
viewer questions to tackle here. All right.
Let's do
So
it.
we're doing tax season right now, kind of the early stages of it, but nonetheless, we're in tax season all the way until I believe April 15th, unless they change the date, maybe a day or two out. But regardless, we do have a viewer question here regarding taxes. So taxes in retirement, that was kind of the topic, if you will. It wasn't a direct specific question about taxes in retirement, but I do think I kind of have an understanding of the general question that is brought here today. So taxes in retirement. So while we're working, most households, and I'm going to just use a married household just to keep it simple here. But there's married filing jointly. Obviously, there are single tax filers. There's head of household, married filing separately. So yeah, there's different tax tables for all of that. I'm going to stick with just one today. That way I don't have to bounce around a whole lot. Let's just say we got a husband, wife in this country. I'm leaving state taxes out because, if you live in Texas, Florida, and a couple other places, there are no state taxes. So I'm going to keep this general. I live here in Kentucky. I got a lot of customers here in Cincinnati. So we'll just say you do have state taxes,
Yeah.
for today's conversation.
Okay.
The taxes in retirement. So you got a husband, wife. Let's just say they're both working. And most people are going to work about 35, 40 years, roughly. So let's call it 40 years. And these days, people are living longer. So healthcare is not getting less expensive. In fact, the expenses for healthcare will likely always have a higher level of inflation to them. But the fact of the matter is, people are just living longer. So the statistic is, for married couples filing jointly, once they hit the age of 65, there's about a 50-50 chance that one of them will live into their 90s.
Oh,
And if
wow.
that were to happen, women would go to about 94 and men would go to about 92. So all of this being said, this is the importance of doing something like a retirement plan or what we call retirement readiness. What's the probability, in other words, that this husband and wife, with the way that they've saved, the way that they've invested their assets, the way that they're planning on withdrawing them, when they take Social Security, how they take Social Security, one taking one, one's delaying one, where they live obviously matters from a state tax perspective. All these different variables, we factor them all in and say, hey, what if we live into our mid 90s? Because like I said, the 50-50 chance one of them might. You might as well plan for that. And if you don't actually live that long, but you plan to live into your 90s, then there's a really good chance you didn't run out of money. So we take all this, all these different variables, and we run it through what we call a Monte Carlo simulation. We use software called Money Guide Pro. It's the number one financial planning software in the industry. When I was at Fidelity, they had a very similar product. Fidelity kind of created their own, but it's very, very similar. TD Ameritrade, we use the exact same product I'm using today for customers, Money Guide Pro. And we take all these different variables, run it through the software, runs a Monte Carlo, which is just 1,000 different market simulations, all the good, bad, and different. And it spits out this probability curve, right? Saying what would be the probability that this individual household will be able to sustain the type of lifestyle that they're looking for throughout retirement. And if we're at 75% probability or greater success, we feel very comfortable telling somebody that their retirement readiness is ready for when they're looking to retire, let's say at age 65 or something like that. So it's very important to do that because we take into consideration your taxes, right? So really simple example, let's say that your lifestyle cost is $5,000 a month, both your fixed costs, stuff you have to pay for, groceries, utilities, stuff like that, and then your variable costs, the stuff you like to do for fun during retirement, which is real simple. $5,000 is the budget, if you will, to have that lifestyle. And let's just say the husband and wife are taking Social Security, and that's $2,500 a month. So it's half of the lifestyle cost. And the other half has to come from their savings. And for the bulk of Americans, the bulk of their actual nest egg for retirement is in a tax sheltered account, usually a rollover IRA, a traditional IRA, maybe a SEP or simple IRA if they're a small business owner, or maybe even just a plain old 401k plan. So they're going to take out $2,500 a month, every single month. And obviously the portfolio has to sustain all of that. So if we're looking at real quick math here, $2,500 a month, multiply that by 12, we got 30K. So that $30,000 coming out of, let's say, a 401k or some sort of pre-tax IRA account, that's going to be seen through the IRS's eyes like a paycheck. So you got your Social Security, that's part of your income. And if you make over a certain amount of money, more of your Social Security will be taxed. So we can certainly spend a lot of time talking about those different strategies for Social Security, maybe a different podcast. If those questions come my way, we'll spend time doing that on the very next one. But that extra 30K that you took out of your, let's call it your 401k, that's going to be seen as a paycheck. You're paying yourself with money that you've put into this 401k account that you never had to pay taxes on. It came gross. So if you made $100,000 and $10,000 went into your 401k account on any given year, the IRS isn't obviously taxing that 10K that you put into your 401k account and only sees you making 90 grand in that example. And all of your gains inside of that 401k, of course, grew tax-free. So now that you're in retirement age and you need to supplement your lifestyle with this monthly distribution from that 401k account, that's going to be $30,000 in this example. And if you are married filing jointly, not taking into consideration the taxes that you'll pay on part of your Social Security income, that 30K is going to put you in a marginal tax bracket of 12%. Now, we say marginal just for those that maybe aren't as tax savants as a lot of CPAs are. I am not a CPA. I'm a certified financial planner, but part of that designation does include a lot of tax conversations. So that 30K marginal bracket of 12%, marginal meaning, let's just say that you made a $500,000 while you're working and married filing jointly. That means your marginal tax bracket is 35%, but it's not truly just 35%. The first, $23,000 is a 10% taxable income. Between 23,000 and 94,000, you're in a 12% marginal bracket. 94,000 to 201,000, you're in a 22% bracket, so on and so forth. So as you hit those brackets, that's where you start to pay, but you're actually not paying, in this case, 12% in taxes on that 30 grand. It's probably going to be something closer to 10% or right around there, right? So that's how marginal taxes work, and that's how your withdrawal from that retirement account will be taxed. Obviously, paying taxes coming out of a 401k account is different than coming out of an IRA account because you're dealing with different tax laws there. So 401ks are governed by ERISA laws, and IRAs are really just governed by IRS types of laws. So what's a good example of difference there? So somebody that's retired that needs to take out $2,500 a month or $30,000 a year, we just talked about how that's going to be taxed. Well, if you're taking that withdrawal from a 401k account, let's say that you're retired, here from Procter & Gamble in Cincinnati, and I don't remember if Fidelity has the 401k or not. I know that they used to, so let's just use them as an example. And let's just say Procter & Gamble employees that are retired, they're allowed to leave their 401k plan with Fidelity. They don't have to. They're not required to. They can do whatever they want with the money. When you're retired, you can do whatever you want to do with those dollars. You can move them. You can leave them alone in the plan if the plan allows that. Let's just assume that the plan allows that, though.
All right.
So you're taking out this 30K. The problem is when you take it out from a 401k account in retirement, ERISA laws require that 20% federal taxes be withheld. Now, you can withhold more than that, but you're required to withhold 20%. Which means you're going to have to take out more than $2,500 a month. You're going to have to take out a number bigger than that, depending on how much you want to have being withheld for taxes. So your net amount after taxes is in fact $2,500, which means you're taking out more than 30 grand, right? So you're also increasing your taxable income at that point. Now, in an IRA account, so let's say that you are a retired P&G'er and you decided to work with Shepherd Wealth Management, you're going to roll that 401k over to an IRA account. It's generally better in retirement to go ahead and do a rollover to an IRA account. One of the reasons being the IRA is not governed by ERISA laws. It's just IRS laws. And again, you're withdrawing money that you've saved yourself pre-tax, so you're paying yourself a paycheck. But the IRA is not requiring 20% taxes be withheld. You don't have to have any taxes withheld at all. You can go up throughout the entire calendar year here in 2024, and you'll go file your taxes, of course, before April 15th of 2025. And you may or may not owe any taxes. Likely you would, right, if you're not withholding anything for federal or state taxes in this example, and you don't have other, deductions or credits to offset those withdrawals, such as charitable things, or you bought an EV and you're getting your EV credit on
Yeah,
your tax
baby.
return. So if you don't have anything to offset that, very likely we'll have some sort of taxes owed, federal or state or both. But those are some pretty big advantages just right off the cuff, just by taking the same assets you have in a 401k account and the difference in how things will be taxed, depending on if you leave it in a 401k versus rolling that thing over to a regular IRA account. So instead of withholding 20%, maybe you do want to withhold some of that IRA withdrawals, but you know that you're going to probably fall somewhere in this 10, 12%, tax bracket.
Mhm.
So instead of withholding 20, why not just withhold 10? Right? It's a huge advantage right there just by moving that 401k asset into an IRA account. Now, the truth being told, 401ks, they have their own rules, right? Like I said, ERISA rules. But the other thing is the employer gets to set up the plan. So they're paying for this benefit for employees, which means they can set it up however they want to, meaning that you might only be allowed to invest in a certain number of investment choices. You may only be allowed to take out one withdrawal a year or four withdrawals a year. Or, hey, by the way, when you leave the company, you can't leave your 401k account here anymore. You have to get it out of here over the next 60 days or whatever their rules are. So there's some major differences between 401ks and IRAs. That's just a little bit of it as it relates to taxes. So obviously speak with a qualified tax professional, reach out to somebody like myself to have those discussions to figure out what's right for you. And we can always make a phone call with any of our customers, and do it quite frequently, to their 401k provider to find out what the rules are regarding withdrawals if they were to retire or separate from employment, and find out all the information so we can build it into the bigger picture, that retirement plan that we talked about. So that's a little bit about taxes in retirement. If there is a more direct question, I'd love to hear it, but that's what I assumed this particular, in this case, customer was looking for. Now, the other question that was brought up here real quick before we get to our big takeaways here, big reasons why we think the market will rise in 2024. The question was addressing required minimum distributions at age 73. So required minimum distributions, what is that first and foremost? So we talked about 401ks and IRAs. These are pre-tax discussions. This would not apply to something like a Roth IRA. So this only applies to the pre-tax retirement accounts. But the government says that, yeah, you got to, let's say, for 40 years, you got to pile money into this 401k account. You never paid taxes on it. All the gains were completely tax-free for 40 years. Now, all of a sudden, you're 73 years old and you've never taken any money out of your 401k. And if you rolled it over to an IRA account, let's assume the same thing. You've never taken any money out. You haven't needed to. Maybe your $5,000 monthly lifestyle cost is completely covered by the Social Security that you and your spouse bring in every month. So you've never had to actually touch all the money that you've saved up in this retirement account for 40 years. Well, at the age of 73, the government says, hey, you're required to take a minimum withdrawal every single year for the rest of your life, because now we want to tax that money.
Hmm.
That's the reason why they do that. Now, it's not the worst thing in the world. I know nobody wants to pay taxes and all that sort of stuff. But if you got to save that money for 40 years without paying taxes on it, and it grew tax deferred, it's not so bad of a trade-off that you now have to take a small withdrawal from that pre-tax retirement account just for the sake of paying taxes on some of that money. So how does that work? There is a table. I don't have the table memorized, but generally speaking, it's going to increase every year. And how they come up with your required minimum distribution amount, for those that are asking or wondering about these types of things, they're going to take the balance of that pre-tax retirement account, which is called an IRA or 401k. Whatever the balance is as of December 31st. So if you're turning 73, in 2024, whatever the balance was of your pre-tax account, and it's not just one account, but they do this for all accounts. The government really sees your pre-tax IRAs and your 401k kind of as one bucket of money. So for simplicity reasons, I highly advise and encourage people to make their life as convenient and as simple as possible as it relates to things like taxes, because the government's not going to miss it, and you might as well make it as easy on yourself as possible to make sure that you're not missing it. Otherwise, if you do not take out this required minimum distribution, you forgot about it. Whatever amount that you were supposed to take out, you'll still have to take out plus an additional 50% of that amount just to pay some extra taxes as like a penalty for your forgetfulness. So don't do that. Now, this required minimum distribution amount is calculated based on the ending balance of December 31st. Let's just say in this example, ending balance December 31st, 2023. So you're turning 73 in 2024. The government's going to take that balance as of the end of December in 23. They're going to take that number, they're going to divide it by a divisor. In this case, it's 27.4. Again, I don't have them all memorized, I just happen to know the first one. And that's the amount that you're going to have to take out. So the great news is the individual investor, the viewer here that's listening and watching this, you're not going to have to do these calculations yourself. So for our customers here at Charles Schwab, this is also true for every other custodian that I've ever been a part of. They do the calculation for you, or at least they give you a tool, a little simple calculator to do the calculation yourself, or for your financial advisor to do that calculation, or your CPA to handle all that. So you don't have to necessarily go about figuring that out on your own. But essentially, if you're increasing your balance every year, if your IRA, your 401k is growing every year, well, the end of every year, they're going to look at it again at December 31st and say, what was the balance? So if that balance is going up, the amount that you're going to have to take out is also going to go up. They generally want to increase your withdrawals a little bit, kind of slow and steady throughout one's retirement. But you'll also have years where, 2022 was a really hard year. It'd be extremely difficult to make any money in 2022. The market was down 20%. The NASDAQ was down like 35%. The only thing that made money was oil, and it's pretty unlikely that any one individual would put all their money in the oil commodity. So if you did not do that, if you didn't have the stones to put all of your money in one asset class like oil,
Well,
there's a really good
common
chance.
sense. Don't do that.
Yeah, there's a really good chance that you lost some money in 2022, which means if you're taking out a required distribution, your future withdrawal, so in this case would be 2023, would be less, right? Because you have less money in that account as of the end of December. So that's how they kind of calculate it. That's how it's looked at. If one were to pass away and the money goes to their kids, let's say, it goes from their rollover IRA account and it goes to my daughter, and I'm over the age of 73, so I've started to take these required minimum distribution withdrawals. My daughter would also be required to take those withdrawals on my behalf. They will have to deplete the account over 10 years, so they can do it over 10 years or kind of do it all in one shot. But they will have to take those withdrawals as well. But it's generally a little bit less for them because obviously they'll be younger when they take that inheritance. So that's the way the required minimum distributions work. There are some really compelling reasons why individuals would want to do something like a Roth conversion before they retire, because the less money that you have in a 401k or a pre-tax IRA, the less your required minimum distributions are, because the government's not requiring anybody to take out any withdrawals from something like a Roth IRA account. So we do advise on clients to do Roth conversions when it makes sense. And typically it makes sense when you have a down year like a 2022, you're converting less money, meaning you're paying less in taxes. And you're doing that because you're expecting the market to recover like it did last year. And any conversion that you do from a regular IRA to a Roth, again, is taxable, just like income. You can't get around that. But by moving some money that you lost in 2022 into something like a Roth, expecting a rebound in 23, now all of that money that gained will never be taxed inside of a Roth. You'll never have that required minimum distribution. So there are some compelling reasons to do that, both pre-retirement and during retirement. But this is all built around the retirement planning process, doing that work up front, so you do have a really good grasp of what is my taxable situation looking like in retirement. How is that going to play into future required minimum distribution amounts that I'm going to have to take out? All this stuff we do for our customers on an annual basis. And when we do that work up front, all we have to do is update it once a year. And if we're managing all the accounts, then that's Pretty easy for us to do because we already know what that looks like. We know what the balance is, the gains, and all that. We understand what our customers' withdrawal needs are, and it's pretty simple for us to update that and say, hey, look, the last time we ran this, 12 months ago, we were at a 85% probability of success, and now we're at 87. And the reason for that is because we had a great year in the market. Your account balances are higher, whatever the case may be. So we kind of give ourselves the ability to track progress. And if we're at 99% probability of success, that's great. Let's just make sure we stay there. And let's also have a conversation about your estate plan because there's a really good chance that you're not going to be able to spend all this money throughout the course of your lifetime. So where do you want this money to go? Charities, family, whatever it is. So all this stuff is baked around a really good retirement plan. But those are some good questions regarding taxes and retirement and require minimum distributions. Cool. So I'm jumping off the financial planning stuff for just a second.
Well, hey, before we move on, I actually have a follow-up question.
Go
You
ahead.
mentioned in the required distribution when your heirs have to take over in the event that the person holding the whatever the IRA is passes away, and they can either take it all out at one time or spread that out over 10 years. Is there a benefit to either strategy? Just for anyone listening that maybe in
Yeah.
thinking
Yeah. Like
about that situation.
a really good example would be like, let's say that, um, you inherited some money from, let's say, a family member that passed,
Sure.
and you know that you're going to have to take this money out, either spread it out over 10 years or do it all in one shot. Well, if my customer was going to be retired before the end of that 10 years, let's say they're making 100K a year and they're going to retire before they have to deplete all this money, I would tell that customer to wait until they're retired and get into a new tax year because you're not making 100 grand anymore, right?
Mm.
And if you're working and you're, let's say, making 100 grand and you have to withdraw this $100,000 from an IRA account, and all of that's going to be taxable to you, well, now you've just doubled the income that you're going to show the IRS. You've effectively doubled your taxes, right? So if you can wait till you're retired, right? If you have the flexibility to do that, I would wait till you're retired. That way you're paying less in taxes on money that you're going to be forced to take out anyway. Does that make sense?
It does make sense. Yeah.
Yeah. So that would work for a unique circumstance like that. It used not to be the case. It used to be, you could stretch out that IRA over the course of your entire lifetime, but the government's a little bit behind on some of their bills, so they got to get theirs.
No way. All right,
Yeah.
well, thank you.
No, you're welcome. So please keep the questions coming. I think we'll get into a lot of this, this time of the year specifically. So I'll probably spend a little bit of time doing this financial planning stuff on future podcasts until we get through tax season at least. But if we get the questions, I'll keep addressing them throughout the entire year.
Yeah,
So I
I
love
just want
that.
to remind all the viewers and listeners drop your questions, in any of the comment sections or in the chat during the live stream. Certainly follow the text thread if you want to give a out of office hours question to Joshua, and anybody that's listening on the Spotify, we give the number out at the beginning and the end of every episode. So just keep that in mind.
Yeah, appreciate that. And so we got three big reasons why we think the market is going to rise in 2024. I talked about this in the newsletter. We touched on it, some degree in the last podcast that we did, the first one for 2024. So there's three things. Most important thing, rate cuts. Second most important thing, earnings. We're in the middle of earnings season right now, actually just kind of kicked off. So over the next 5-6 weeks, we're going to hear all about corporate America's earnings and expectations for the current quarter that ran Q1. And the third thing that's really important is the unemployment rate. So I'm going to spend the bulk of this on the rate cuts because that is the most important thing. That's what's on the market's mind. That's what's on investors' minds. That's what's, I think, causing some of the volatility that we're seeing right now. So the market is pricing in 6 interest rate cuts in 2024, 6 of them at 25 basis points per clip, which would basically bring the Fed funds rate down to 3.75 to 4%. Right now we're at 5.25 to 5.5%. So that's what's baked into the market right now. Now, currently speaking, there's about a 70% probability, according to market data, that the market is expecting a 25 basis point cut in the Fed's March meeting, so coming up here in March. And of course, the rest of the cuts are spread out through the calendar year of 2024. I'm not going to argue with the market. I think that there are a whole bunch of reasons why the Fed should cut rates in March. And we could talk about it and debate it, but I don't think you're going to see a rate cut in March. I just simply do not see that happening. It was kind of told to us when we got to look at the Fed dot plot here in January. They also gave us a little bit of an idea of what they're thinking about rate cuts. And I want to give a specific quote here if I can find it real quick, as yeah. So essentially, all these Fed members, as I'm scrolling through my notes here, are admitting that there will be a need to cut rates in 2024, but they're just not in a hurry to do it. In fact, they go on to say that if inflation were to peak back up for whatever the reason may be, they would be comfortable with actually increasing interest rates by another 25 basis points. So as long as the economy holds up and inflation continues to track towards this 2% long-term target the Fed is looking for, which it has been all year long last year, and so far the data that we've gotten this year would be the same indication that we will get a rate cut. It's just a question of when and how many times. And the market is forward looking. It's trying to price into securities right now, every second that the market's open, when the Fed is going to have the rate cut. And the more cuts they do, generally speaking, the market would love it because it makes the cost of financing operations less for corporate America, meaning that their profit margins should be healthier with a lower cost to fund their business operations. And the other part that makes things more compelling for stocks when interest rates are coming down, everybody that's trying to evaluate the fair value of any individual stock is using some sort of discounted cash flow model. So if your discount rate is less, meaning because Fed is now cutting rates, the present value of those future cash flows of whatever business you're evaluating is actually going up, meaning the stock price in general should also go up, not factoring in any other macroeconomic event. So rate cuts. I think that the first rate cut is going to be in May. And the reason why I feel that way is the data is still compelling and telling us that inflation is in fact falling. I just think that these Fed heads are going to be a little hell-bent on taking their foot off the economy's neck, if you will, from an interest rate perspective. They don't want to give their hand, if you will, to the market because the market would just simply take off. If they knew exactly when the Fed was going to cut rates, how many times throughout the calendar year, it would already just completely take off and try to price all that stuff into securities right now. And I don't think the Fed is necessarily looking for that to happen. They also don't want to, destroy an economy that is actually humming along quite nicely while the Fed increased rates to over 500 basis points in really less than 6 months, which we've never really seen anything like that before outside of 1980s when we were also dealing with a bit of inflation there. So yeah, the market took it in stride. The economy is holding up very nicely, even though the Fed has been on a interest rate increase cycle. And now we're looking at decreasing those interest rates because the economy's held up quite nicely. I think we see our first cut in May. Now, what does that mean for investors? I think that we'll see 4 or 5 cuts. I'm in the 4 to 5 camp, not the 6 camp. I think if we got 6 cuts, that might be a bad indication for the market that the Fed's held on too long and maybe have caused some sort of minor, recession in the marketplace there. I think that's the only way that we get to 6 cuts. But the market's going to be very antsy. I think it is right now because it really can't figure out what the Fed's going to do in March, even though they're pricing in a 70% probability of that happening. So if the market's pricing in 70% chance of a rate cut and we don't get one, which I don't think that we will, the market's really going to be annoyed by that and wondering, well, when the hell are we going to get our rate cut, right? And because of that uncertainty and the fact that the market's made up of human beings, and when uncertainty rises for human beings, what we've learned from behavioral finance is we go into preservation mode. Meaning we like to sell shares of stock.
Yep.
Meaning that I do expect volatility to happen when they do not get their rate cut in March. And if we do get that rate cut in May, and I'm right, let's say we get 4 or 5 of them spread out 25 basis points at a time for the rest of the year, that means most of your return is going to be in the back half of the year, right? Last time I checked, May is the 5th month. So that's about the midpoint, meaning that most of your return will come when that actual first rate cut happens. Which means what we're doing for investors is we are participating in the market. We talked about this in our last episode. Our favorite sector when we're in an interest rate cutting cycle, again, that's the most important thing to keep your attention on, is when the Fed starts to cut rates. We love small caps. They tend to perform historically really well as interest rates are coming down because of business have to finance their business operations. Typically, it's very short-term financing, typically around 12 months, 18 months. So as the cost of financing their operations comes down, like we talked about, present value, future cash flows should go up. That's been an unloved sector of the investor space for quite a while now. It's underperformed the S&P for 12 straight years. And the other nice little kicker with the small cap index, the IWM, the ETF we use for that, the Russell 2000, 30% of that index is financials, typically regional banks, community banks that are publicly traded. And as the cost of financing business operations comes down, loan demand goes up. That's how banks make their money. So we like financials as well. We like Berkshire Hathaway, of course. We're doubling exposure there because it's actually the biggest weighting in the financial sector ETF. We don't own the ETF. The XLF is what I'm talking about. But if you actually look at the underlying holdings of that, you'll find Berkshire is their largest holding, even though they're not a bank. They own a lot of shares of Bank of America, but Berkshire is a conglomerate of a whole bunch of different businesses. But it just happens to be 12% of the weighting of the XLF, the financial sector ETF. So as investors come out of cash and start to pile into financials, why do I know that you guys are going to do that? Because I know that the news is talking about buying financial stocks, bank stocks. Every day that I have it on the news, every time I pull up something from Barron's, there's another reason why you should be buying, the financial sector or bank stocks. So as you guys take your money out of cash and you start to deploy that in ETFs, like the XLF, well, the biggest buy there is going to be Berkshire Hathaway. That's about 11, 12% of their holdings. The next biggest one is JP Morgan. Therefore, because we love Berkshire Hathaway for so many reasons, and we like financials because of the interest rate cutting cycle we're about to go through, we've doubled our exposure to Berkshire Hathaway. We love industrials, Lockheed Martins, the Boeings, Caterpillar, John Deere, all those big industrial types of companies. Cost of capital is coming down due to rate cuts. It's great for their business also. And the other great part of that sector of the market, being industrials, is the government's now going to be spending a couple $1 trillion over the course of many years of building chip factories, fixing up, highways, airports, hospitals, all those types of things, which is going to benefit industrial players as well. And of course, we love technology. That was the big win for us last year. We're just going to own less tech. I just don't think tech's going to do 50% like it did last year. I mean, I'd love to be wrong about that.
No, well, it had so much room to go to make up for what it lost that, so.
Exactly. Yeah, there's a huge cash-up trade for tech after a terrible year for tech in 2022.
Right.
We made a bunch of money for our customers in tech. Tech's 30% of the weighting of the S&P. We were way overweight tech last year, meaning we had a lot more exposure than 30%. And at the beginning of this year, for taxable accounts, for IRAs, we did it, in December, late December. We rebalanced. We took a lot of gains out of tech. We brought tech down to about market weight. It's called 30-35% of client portfolios, which is about right in line with where the S&P's weighting is for tech. And we took those gains, we put them into the places I just talked about: small caps, financials, Berkshire. Forgot to mention home builders. Again, as loan demand goes up, we already have a huge pent-up demand in this country for building new homes. We're about 5 million short. So that will increase, quite kind of like a no-brainer to me as interest rates come down. And of course, industrials and technology, like I just mentioned. So keep your eye on rate cuts, knowing that the market's going to not like the fact that they're not getting a rate cut in March, in my opinion. Now, if I'm wrong about that, I hope to be wrong about that more so than anything else. But I do think that it would be great to see a rate cut in March. Market's not going to like that; they're not going to get it. So I do kind of expect a lot of volatility. I think that we'll likely see potentially a new all-time high on the S&P 500 over 4,800 on the S&P. I think you'll see a close or at least an intraday market high, a new all-time high, sometime here in the month of January, because the second most important thing is earnings. So we're in earnings season, as I mentioned. Corporate America and analysts are counting on about 11 and 12% earnings growth throughout the calendar year here of 2024. That's a very healthy earnings growth. And if that holds up, obviously the market's going to like it because you got two really good ingredients for double-digit type of performing year for something like the S&P 500. If earnings are growing 11, 12%, and we know that we're going to get rate cuts at some point, that's some really good ingredients for market growth. But because market's not going to like getting the bad news of no rate cut in March, you're just going to have to wait and see. when we do rate cuts some other point in time in 2024. Even if earnings are good, like I said, you could get a really nice run here for the S&P. Potentially, I'm expecting a new all-time high sometime in the month of January, and I'm likely going to sell into that. I'm likely going to take some short-term profits for our customers, raise some cash, and as the market comes down, let's say from 4,800 down to 46, maybe even 4,500, that's where we want to begin the dollar cost average back into the exact same stuff that we want to be positioned in the most for our customers leading into the month of April, expecting and anticipating an interest rate cut, the first one being in May. So we will keep an allocation towards equities. We're not jumping out of stocks into cash and then from cash all back into stocks. Do not want to miss, the market under some of its very best days. There's a whole bunch of data out there. If you're a 30-year participant in the market and you miss the 10 best trading days, your return, nearly gets cut by like 25% or more, 30%. So there's a lot of reasons to stay in the market, and we're going to stay in the market to, protect our clients in that way, even though we do expect volatility, but we're raising some cash in anticipation of that volatility to take advantage of it before we get to our first rate cut that we're anticipating in May. So earnings, second most important thing. I expect earnings to be very good. And the last thing that's really important to keep an eye on is the unemployment rate. We just got that data, I think about a week or so ago, Ez. It came out early January, and unemployment rate under 4%, still 3.7%.
Right.
I mean, yeah, it's awesome. Everybody that wants a job has a job.
Yeah.
And that makes up 70% of our economy here as consumers. So as long as the consumer has money to spend, they will consume.
Yeah, you have
and
to.
that's you do. It's kind of the way this U.S. machine has been
It's really
created
not
and
optional.
adopted.
You got to buy stuff.
So they're going to consume, which is great. That means earnings should hold up. And as we get closer and closer to an interest rate cut, the market's going to love it. So expect the bulk of your performance to happen in the back half of this year, and also expect some volatility as we are getting closer to wrapping up earnings season and getting closer to what the market's hoping for, which is a first interest rate cut in March, which I'm simply not anticipating will happen. And our price target for the S&P 500, 53.40. It's about a 12% increase from where we ended last year. And the reason why we're shooting for that is because when you have a Democratic incumbent president rerunning for office over the last 100 years, the S&P 500 has averaged exactly 12%. So I'm sticking with the probabilities and what market history has to say. And for all those that are wondering why we spend so much time talking about historical market data and using that data to kind of formulate an asset allocation and a game plan for our customers' portfolio, it's because Warren Buffett famously said the one thing we know for sure about human beings is they do not learn from history. So we do spend quite a bit of our time looking at history because it controls my temperament, the emotions, those 27 different emotions that could be going on for me or any client of ours at any one given point in time. How do we control all that when we got, job, obligations, kids, family, all this stuff? Is when I look at what history has to say, I know that the market's made up of human beings. Human beings have not changed hardly at all in over 2,000 years, which means if we don't learn from our prior historical moments, there's a very good chance we're going to miss out on opportunities. So I expect human beings to repeat their behavior. Now, past performance is not a guarantee of future results, and investing does involve risk, including risk of loss for all the compliance people listening. But when I understand what the human being has done historically, and there's maybe 10, 12, 17, 25 different other instances that were very, very similar to stuff that we're going through right now. And here's what happened in these different market sectors over the next 6, 9, 12 months. That controls my emotions completely when it comes to making an investment decision. Now I have confidence, just like in the individual that runs that retirement analysis, right? And they're 93% probability of success. They're very confident going into retirement, knowing that they have the resources and a game plan to sustain the lifestyle they're looking for. When I look at what history has to say about all these headline risk, issues that you get alerted on your phone, well, if I find out that there's 17 other instances and here's where things landed in various sectors over the next 6, 9, 12 months, I'm in complete control over my emotions. Now I can formulate an asset allocation, a game plan, and some actual return expectations for customers. So that's the reason why we do this show more than anything, is to provide you guys with this historical data and arm you with it so that you can keep your emotions under control and very likely make much better decisions and repeat success with your investing on a consistent basis. It's one thing to do it once. It's a completely different animal to be able to do this really well for a very long period of time, much like Warren Buffett himself. So those are the three reasons we expect the market to rise mostly in the back half, and three really important things to keep your attention on. And as that wraps up today, my friend, unless we happen to get one last question or somebody popping in, I do have a text message here, but it has nothing to do with any questions. It looks like the quarterly review
Oh,
that I got to get to for customers. So
all right.
we'll do that unless you got anything else, as.
I do not. Do not.
All right.
Nothing
Well,
popped up in chat, so maybe we'll see some comments once we post this to the page here on Monday. So
yeah, I love it. So we'll do this again in a couple weeks. Check us out, shepherdwm.com. And you can find all of our YouTube videos, podcasts, newsletters, everything about us, what we're about, how to reach us with your questions. And look forward to taking those questions and providing our answers a couple weeks from now. So we'll drop this live in YouTube in a few more weeks. And we look forward to seeing you all there then.